Does Warren Buffett really pay a tax rate of just 0.1% when us hardworking Americans pay on average 14.5%? Well, not really. You see, anytime we're talking about tax rate, we're generally talking about an effective tax rate, which is calculated simply by taking your tax liability divided by your taxable income. Now, some tax accountants, myself included, like to do a modified version of it, where we take the denominator and we use a gross income. The reason for this is because a lot of people know their gross income, but not their taxable income. You see, pretty much everyone knows their gross income because it's just the sum of your wages and salaries. It's pretty straightforward. But your taxable income is a function of your gross income less any deductions against maybe some sort of qualified 1099 income like self-employment, less above the line deductions for things like maybe HSA contributions or student loan interest, less the standard or itemized deduction, whichever one's more advantageous, and then that's going to give you your taxable income, which again is a number that many people don't really know off the top of their head. What's nice about this modified calculation using the gross income as a denominator, it actually makes consultations much easier when it comes to tax planning because we can use this as a guide in order to get a better feel for your withholdings or estimated tax payments, like filling out your W-4 correctly. So that way you're not going to get surprised, again, come tax time. But the problem with Warren Buffett's 0.1% is it takes this function and takes it even further by making the denominator the growth in wealth over time. The problem is growth in wealth by itself is not necessarily income. You see, you can quite literally become more and more wealthy, but as long as you don't sell whatever is making you wealthy, in this case maybe like real estate or stock, as long as you don't sell it, it's not income. And if it's not income, it's not subject to income tax. And see, when it comes to comparing Warren Buffett's 0.1% tax rate to our on average 14.5%, we got to level the playing field in order to make a fair comparison. So looking at Warren Buffett's, again, I couldn't find actual tax returns. And again, granted, I only spent like 2 minutes even looking, but if we actually had the tax returns, we could plug it into these formulas here in order to get a true effective tax rate. But since his effective tax rate of 0.1 actually includes wealth growth, and our 14.5 probably doesn't, well, let's look at the 14.5. So if we're lucky enough to have a retirement account or have a house, which again generally appreciates in value over time, we got to add that value into the denominator, which again we usually don't because it's not taxable. So this is even more modified effective tax rate. And once we do that, our 14.5 is going to tank because again, we're just going to increase the denominator even further. So does Warren Buffett really only pay 0.1% in tax? Well, if we use this bottom calculation, yeah, I can see that. If we use the modified version, it's more of a stretch. Probably a bunch of itemized deductions are needed in order to get that low. But if we use the conventional way of calculating your effective tax rate, I don't see how 0.1 is actually realistically possible.